All right, all right. Good morning, everybody. Welcome to another webinar here by FCI Markets. My name is Justin Paolini, Head of Trader Development. We're starting right on time, basically. I would just like to know if you can see my screen, if the audio is okay. If you can just give me a thumbs up or let me know. All right, it seems that all's good. Perfect. Well then, let's get this show on the road. Today we're going to be talking about market mind games, but before we start, as usual, please read the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, as usual, by now, you know me. I spent most of my career on the retail side until I recently graduated onto the institutional side, providing institutional analysis to clients from 3canalysis.com and being head of trader development here at FCI Markets, working with some of the best traders in the world. Let me also remind you why we are doing all these webinars and why we put out the educational content on our YouTube channel. It's because we want to give you the tools to become consistent traders and to help you simplify your trading habits, because we want you to become professional traders and come and join us at our offices in the UK or trade remotely, because we have the capacity to fund you if you have sufficient statistics to prove that you are consistent traders. We have an academy that I'll show you at the end of this presentation in case you don't have a system yet and you want to become a professional trader, trade for a living. And we are developing copy trading services as well, which should be ready sometime in October. So we do have a series of solutions for you in order to bring you onto the professional side of things. And these webinars are to help you simplify your trading habits and learn, some of the good practices that we use and that have kept traders profitable through various market cycles over the years. So into market mind games. I guess the premise to all of this is that in the conversation that I had with Kevin, with our head of trading, he actively dismantled the majority of this presentation the way I had originally planned it, because I was a little bit on the philosophical side, and he starkly reminded me that successful trading isn't all about psychology. I mean, psychology has its place, and the proper mindset has its place in trading, but only if you're already doing the right things, because it's a numbers game first and foremost. It's about technique and it's about numbers. The psychology only happens afterwards. So so I guess what I'd like to say is that he's really helped make this presentation as essential and as to the point as possible. And I really hope you enjoy it. The premise I'd like to start with is that most traders make an absolute fortune trading on the demo. However, when they then move to a live platform, trading real money, they just can't make ends meet. So where's the difference? Why is there this gap? The gap is usually in the mind. What we need to start with, though, talking about good trading habits and relieving pressure, relieving that mental pressure that drives people insane and never allows them to become successful at trading, is the numbers game. Okay, you've seen this chart many times, and as Kevin said, repetita juvent. Repeating things multiple times helps drill it into your head. We need to understand that one of the main issues, and we'll talk about this later, one of the main issues is losses. Our everyday life, our schooling, so many corporate environments teach you that losses are bad. Being wrong is bad. Now, when you come into trading, you can't really think that way, because otherwise you'll do everything you can to avoid losses. And that creates poor trading habits. What we need to do instead is remember the relationship between risk reward and win rate. The higher your risk reward of your trades, okay, so translated into proper trading statistics, the better the relationship between your average profit and your average loss, the less you have to worry about win rate. Okay, most traders come into this game, just like in the previous webinar that we did on trade management. Most traders come into the game trying to have a 70, 80, 90% win rate because they just hate to lose. And so they structure their whole trading career on trying to be right, which is futile, because their whole mindset is connected to not losing. And so they do everything possible, martingaling position size to make back losses, scalping for small gains because it gives them psychological pleasure, etc. They do everything wrong just because their whole mindset is centered on this win thing. What professional traders know is that you shouldn't have to worry about the win rate at all, because it's not about how much you win. It's about how much you win when you win and how much you lose when you lose. So, long story short, to start off, on the right path, ensure that you have ways of running your profits and try not to take 1 hour losses. Okay, accept that there will be losses, but always remember the mathematics behind average win to average loss and the win rate. Okay, we need to be in a place where we don't have to fret about losses, because losses are part of this game. Now, to further drill this into you, this here is a chart, okay, where I've taken an arbitrary number of 20 trades. Now, if you're a day trader, then you might take 20 trades in a day. If you are a swing trader, you might take 20 trades in a month. If you're a position trader, you might take 20 trades in a year. So independently from your profile, your risk profile, 20 trades, what is the probability based on the binomial distribution? Okay, what is the probability of having X successive losing trades over the next N trades? Okay, so we're asking ourselves, what is the probability of having, a number of losing trades over the next 20 trades? So let's say if you got 20 trades in a day, what is the probability of having 2, 3, 4, 5, 6, 7, 8, 9, up to 10 consecutive losses that day, depending on your win rate? So let's say you have a 50% win rate. Okay, let's not call ourselves geniuses. Let's say we have between a 40 and 50% win rate. How many losses, how many consecutive losses should we expect and should we prepare for? Well, for sure 2, for sure 3, for sure 4. Depending on our win rate, whether it be for around 40, 50%, maybe we'll have 5 consecutive losses in a row. Okay, maybe 5 or 6. That's more or less the cutoff rate. Okay, and we really shouldn't have 7, 8, 9, or 10. They are possible. The odds aren't 0, but between 5 and 6 consecutive losses in a row. Now, if you're a day trader and you're trading 20 trades per day, you have to price this in. People don't think about this. People only think about the upside. They focus on the profits. They focus on winning. So they never think that they might lose 5 or 6 times. And this is just, this is normal math. Okay, anything could happen. You could have a statistical fluke, and you could have 20 trades that are losses in a row. One trader I spoke to who worked for Caxton, which is set up by Bruce Kovner, the market wizard. This trader worked for Caxton, and he had 29 losses in a row. So my question was, how did you feel? He said, I felt fine, because my position sizing model was fine-tuned to allow me to survive forevermore. I can take all sorts of losses and I will never be out of the game. Okay, so again, as traders, we need to think about controlling the downside. Because if we can manage the downside, if we can survive the worst case scenario, if we can survive, the consecutive losses, then and our profits, our average profit is much larger than our average loss, then we will always recover from our drawdowns quickly and efficiently. And we will always have a Sharpe ratio above 1 because we are efficient risk takers. But people that do not factor this in, people that never think about consecutive losses and accept the fact that they will have consecutive losses because each trade is essentially random. Your expectancy develops over time, but each trade is really random. Okay, they never think about this. And so if, let's say, they lose twice in a row and they start to double their position size, but they're still well within, the statistical, normality. So let's say they lose again, and now they're in a bigger hole, and they say, okay, 3 losses in a row. Well, the next one's surely going to be a winner. No, it's not. The next one is probably going to be a loser anyway. And they get another loss. So now they've doubled their position size again. They've taken a bigger loss. How far down into a drawdown have they gone? Trying to make back their losses, ignoring the math behind, trading and betting in general. Okay, so we need to start with the right mindset. And the right mindset is always remembering that your wins need to be larger than your losses, because then you can tolerate losses. You don't need to worry about them because your wins will take care of them anyway. The second thing is that you should prepare for consecutive losses, and you should make sure that your position sizing model allows you to take double the amount, because that's basically the industry practice. You take whatever the statistical odds are. So let's say that you have pretty good odds of having 6 losses in a row. Okay, double that, and then size your positions based on that worst case scenario. That way, you're trading at a size that is so small that over time you'll grow your account, but you will never be in a position to lose all your chips, and you will never be in a position to worry because you can never be kicked out of the game. But people don't reason like this. And so that's what starts to create all the mental pressure. This is the other thing. There was a story many years ago, Toyota, the great recovery of Toyota, the car maker. And the way they did it was kaizen. Okay, we need to take kaizen into our trading and realize that our trading results are a direct result of our skills and our drive and our commitment to enhance our trading model, to make it better and better and better. Okay, so we're trading, and then we stumble upon a problem. For example, our losses are still too big compared to our profits. Okay, perfect. We have to face that reality, and we have to know it's a problem. We have to develop countermeasures. Okay, what can I do in the meantime? While I'm trying to find a solution, what can I do in the meantime? Okay, for example, when I was trading back for a signal provider, I'm at a certain point in 2016, we ran into a big drawdown. And as we started losing, the wins were much, much smaller than the losses. Okay, what did I do? What's one of the only things I could do back then until we solved the problem? Cut the position size. And I cut it down to a quarter. So if we were risking 1%, we're then risking 0.25. And that frees up capital. That allows you to make more and more mistakes until you determine the root cause. Determine the root cause. Is it you? Is it the market? Is it your system? Hypothesize a solution. Okay, test a solution. Okay, and see if it works. Implement the solution, and then see what the results are. Take stock of the results. Analyze them. How are things going? Do we have another problem? Okay, well, you just go around and around. And Ray Dalio gave his own description of how you do this. But essentially, it's the same process. It's continuous improvement. Okay, we have to do this as traders. We can't remain static. We have to continue improving and improving and improving, because there really is always something to be done. We need to get to a place, however, where we have reasonable odds of success. So once you have average profits that are bigger than average losses, once you have a Sharpe ratio above 1, and once you have worked a position sizing model into your trading that allows you to never worry about losses, you're in a pretty good spot. Okay, because it means you got your trade management down. It means that you know how to select your markets, etc. But notice how all of this goes back to the trading process. Okay, it is the focus here, and this is what Kevin really wants me to drill into you today, is that remove pressure and allow you to remain objective. If you don't follow, the mathematics of trading, you will have issues, and those issues will contaminate your mind and it will add pressure. But if you do things right, if you structure your trading process correctly, you will automatically be in a better mental place. Okay, so it does go back to the process. We need to be very, very transparent. We need to accept this reality. Okay, and that is that to make money in the markets, you need to have a positive expectancy. Now, the positive expectancy means average profit times win rate minus average loss times loss rate. And that has to be bigger than 0. How do you do that? You need to have a process to follow. You need to have a trading system you have tried and tested, okay, and that you understand, and that's fairly simple. You need to follow that process because issues will pop up if you don't follow the process. I mean, I was actually talking to a trader yesterday, a trader who I've taught, and for some reason, he goes off on a tangent. He doesn't follow the process. So why don't you follow the process? Okay, you can analyze that, but essentially, to make a long story short, just follow the process until you understand. And you can ask questions. You can always get in touch with us, ask questions, but stick to the process unless the process isn't working. Because if something isn't working in your trading and you're executing the trading model, in a fairly mechanical way, you can then dig into it and understand what's going wrong, what you need to work on, and use the kaizen wheel to improve and then see what's happening. But if you don't follow the process, and unfortunately many traders fail on this because they just don't have the discipline, or they just go off on a tangent, then issues will appear. With the kaizen model, enhance the process. We're always learning. Doesn't matter how long you've been in the markets, you're always learning. Nobody has all the information. Nobody has this game perfectly solved. And measure the outcomes, okay? Because we always need to have the data at hand. We always need to have cold, hard data to remind us of what needs to be enhanced and what is working well. Okay, so I've taught my system to a number of people, and yet the results are variable. Nobody has exactly the same results. Now, this is a bit down to risk tolerance, to personal preferences, to day trading versus swing trading, but the recipe remains the same. And there are some people that have never really gotten to that stage where they can aspire to get funded. So why is it so hard to follow a process, even though the process is 80 to 90% systematic? It's the market mind games. It's the games that the market will play on your mind if you don't stick to the process. The first thing that I'd like to talk about is that wrong mindset. Okay, most traders do come to the table with that winning is good, losing is bad mentality. Okay, so they spend all their time trying to find ways to win. That's why most traders try to analyze. They overanalyze and they just dig into setups. And our most popular video ever since we started doing webinars here at FCI Markets, the most popular video by far was the first one, which was how to develop consistent trading ideas. Right. So basically, where to look for setups, how to identify opportunity. That's the most popular video. So once again, habits don't change. People are just attracted to that thing. How can I win? What do I do to win? And the fact is that they never mentally prepare for losses. Okay, this is all good. I mean, we need to use setups. We need to get in the market with some kind of behavioral trait, some kind of repetitive behavioral trait that gives us an expectation, over time of something that happens that's favorable. But that's just one component. Instead of focusing all our efforts on that, plus the statistical trickery of martingale or whatever, we need to start on the opposite side. We need to invert this mentality and prepare for losses. Because if you never mentally prepare for losses, you'll never accurately size your positions. You'll never investigate how to run your winners because, after all, you're trying to win. As long as you can get wins, doesn't matter how big, then everything is good, right? and they use martingale position sizing strategies to make up for losses. And I see this again and again and again. The most popular strategies on the social media platforms, on the social trading platforms, basically use martingale position sizing strategies to make up for losses. And they have 90% win rates. And that's where most of the money flows to in the retail space. It's ridiculous. And these, they have a survival rate that is always questionable. And unfortunately, we will never fund a strategy that hinges on a win rate. Okay, because it doesn't make sense. And what happens then, since the traders never prepare for losses, is that they never really gain that resilience to fight back. They never roll up their sleeves and work on position sizing, work on trade management in order to fight back. And what they do is they just look for another strategy. End of story. And they go back to the videos like our most popular video, right? Generating consistent trading ideas. Another setup, another way to win. Maybe I need a better way to win. So you can see that, trying to win is the wrong mindset. The second thing that I've seen is that traders don't really develop a process in the first place. Okay, it is impossible to have discipline, emotional stability, and not fretting over uncertainty in the marketplace if you don't know exactly how to select your candidates, how to rank them, what exactly stacks the odds in your favor. So, what market conditions favor your system over another. What levels or what kind of setups allow you to have a higher risk to reward ratio. Because remember that having a high risk to reward ratio, having a high ex ante risk to reward ratio is an advantage. Okay? As long as you can execute those bets that will give you a superior risk to reward ratio, you'll be okay in the long run. So, understand what allows you to get that. Then, of course, you need to know how to execute your trades properly because, even the best laid out plans, if executed miserably, won't deliver. And then, try to manage your trades. And we've talked about this. We've talked about execution. We've talked about management. We've talked about trading ideas. So, go back and watch those videos if you need to. But we've talked about all this. There are no real secrets. The secret sauce is what you give it. It's what you take and create. Okay? Each trader will have a different way of doing this. But there can be no calm or collected decision making unless you know exactly what your plan is. Okay? And if things are going wrong and you don't have a precise process that you're following, then you don't know what to change. You don't know what to prune and what to enhance. Okay, and this is why demo trading or trading with very small size at the beginning of your career is important, because you need to give yourself the time to study, to backtest, and to understand, and enhance your system and get to that point where you are consistent and you do have a battle plan for all contingencies on a demo or on small money. And then you can start scaling up. Then you start trading always within your, your risk parameters, but at least you have a plan. And so many people just never get to that stage. The second thing is the discussion on money. I'm just going to have a quick sip of water before I continue. Okay, so money. What I've done here is I put a picture here from the Maslow's pyramid. Okay, the hierarchy of our needs, and it goes from the physiological needs to safety, to love and belonging, personal esteem, and then self-actualization. Now, most people, that I've been in touch with over the years, just want to trade to make money, but they actually don't enjoy the process because they hate to lose. They go in there with that same mentality, and they treat it like any other 9-to-5 job. We're just showing up and doing certain things will allow you to get by. That's not what trading is. Trading is a competitive environment. You always have to be at your best, and you have to know exactly what your game plan is. So they get stuck because their expectations are skewed. But then the other thing is that money is connected to everything in this pyramid except for self-actualization. So because money has to do with covering our physiological needs, having shelter and a warm bed, having clothing, having food, safety, being able to buy a house, having savings to face unexpected expenses, love and belonging. Without that kind of security, without that kind of safety, you can't really build a family. And esteem. People always ask you, what do you do for a living? One of the first questions when you meet somebody new, they say, okay, well, yeah, nice to meet you. So what do you do for a living? And people like to say, I'm an important businessman, or I save lives. I'm a cardiologist, or I'm an expert technician at a big company, and I make sure that you can get your cereal boxes nice on time, etc., whatever. Esteem. People, unfortunately, have, even nowadays, even after all the books that have been written, it isn't something that grows from within. People aren't taught to grow their self-esteem from within, of who they are and what their rights are. They look for external confirmations, and usually this also is connected to money. So bottom line, money affects everything. And so people come into this trading world thinking that they will feel good when they become traders. They will be happy, they will be fulfilled, but it doesn't really work that way. Number one, they don't really know what a great trader looks like. Okay, they think the great traders never lose money because, again, it just goes back to that same mentality. Losing is bad, so I need to win. Okay, and people generally can't stand uncertainty. They can't stand the fact that you can't know everything in the markets, because if anybody had perfect information, they would move the markets to reflect that. And that's why the markets are forward-looking. The market, even like yesterday, a couple of Australian banks downgraded their forecast for the RBA. So the Reserve Bank of Australia is now forecast to cut rates in October. It's going to be a live meeting. This wasn't known previously. And even though it's a speculation, the markets have already reacted and they've discounted that. Yesterday, the Australian dollar was the fastest moving currency during the Asian session because it dropped like a stone on these revised forecasts. So the markets absorb information as participants learn things. So uncertainty will always be there because we are always, we're always betting without knowing what's going to come out in the future. We're betting now based on our setups, based on our experience, based on our trading system, expecting the future to materialize in a certain way. But there is no certainty. The only thing that will keep us alive and well is the mathematics of trading. So running our winners, cutting our losses. Okay, when things don't work, having a way to do that, which is trade management, and making sure that we are executing our system only when the odds are in our favor. So, that's how you tame uncertainty. Now, the other thing is most people really don't know, what the job of trading entails. It's tough. It's competitive. It's not just about being there. It's not just showing up every day. You have to be at the top of your game each and every day. So, furthermore, since markets are about using money to make money, they have this firm grip on our identity. And if you are looking for evidence of how much you're worth, if you're looking, if you have to feel good, if you're looking to become a trader because you want to feel good about yourself, you're probably going to be disappointed, because the outcomes of your trades have nothing to do with who you are as a person. And this is something that a lot of people struggle with, including myself back in the day. I mean, trading doesn't give me personal fulfillment because it's only money, right? It's very intangible. We are social creatures, and most of us have much more fulfillment and much more enjoyment when we are interacting with fellow human beings. And that's why I'm a coach. That's why I'm a trading coach, and I hopefully will be going back to school to become a licensed therapist, because I've learned that I love helping people, and trading is just something I do. It's something that I've worked on for a long time. It's something that I enjoy. I enjoy the markets. I enjoy following the markets. I enjoy certain things about the markets. But the actual act of betting, of financial gambling from a certain point of view, is something I don't enjoy. But so it's like a job, just like any other job. There are pros and there are cons. But the outcome of each single trade is uncertain, and it's quite random, and you can't force that. So if you're tying your self-worth, if you're feeling good about yourself when you win and you're feeling bad about yourself when you lose, you're going to be an emotional wreck if you try and trade. You have to detach your results from who you are as a person. Okay, they have nothing to do with one another. You can be a great person, philanthropist. You can be helping your neighbor with her groceries. An elderly person with her groceries. You can be donating, and you can be a poor trader, but you're doing all sorts of great things on the side. So your trading results have nothing to do with who you are as a person. They need to be detached. This is just a job, and most people can't keep those things detached and disconnected, because money sort of connects everything in our lives. We let money interact with everything we do, everything we are as people, etc. So again, money matters. And it was Paul Tudor Jones who said, I try to make myself as happy as possible each day. And that's because trading will otherwise make you quite miserable, because there really never is the perfect scenario. There's never the perfect trade. You're always getting out, before, you're not catching tops and bottoms. So you're always getting out when the market has more to give you. Sometimes you get stopped out right where the market is turning. Sometimes you get stopped out and the market will then proceed and it was just a volatility spike. Sometimes you miss an opportunity. There's all sorts of stuff that can be very frustrating. And even when you execute your plan, sometimes things go sour. Okay, so that's why you have to cultivate a life outside of trading. Trading has to be something you do, but it can't be more than that, because it is extremely frustrating. Okay, and mindfulness, self-awareness, and gratitude really help center yourself. They really help you get on the put your right foot forward before you jump into the markets each day. Now, talking strictly about psychological pressure, a big lesson I learned back in the day was that you can't risk money you don't have. Okay, and I had made the mistake of giving up stable employment to trade the markets. And the psychological pressure that you're under is tremendous. So learn from me. Don't do it. if you need money, you can't trade. Now, equally, wealthy people that have too much money usually can't trade well either, because they, unless they've made it, from the ground up, they don't really have the respect for money that you need to have. Okay, so the solution here is, just realize that trading is another form of gambling, and it does take time to develop an edge. So don't leave your day job. Learn to trade around your day job, and only risk the money you can really afford to lose. And don't risk it all on one trade. Okay, so bottom line, this is how you really reduce pressure, and you make sure that you can remain objective in your decision making. Uncertainty. How do we deal with uncertainty in the markets? The uncertainty that causes so many people to, to go off on a tangent and have, emotional responses. Our trading systems. Trading systems are an attempt to give a structure to all this uncertainty, to bring order to the randomness of market fluctuations. Okay, it is your trading system. It's your process that helps you deal with uncertainty. It's not magic. It's not belief in yourself or whatever. It is the structure. Okay, your trading results will always be uncertain in the short term, and it's only in the longer term, okay, over the course of 20, 30, 40, 50, 100, 1,000 trades, you really see your expectancy, you really see your edge being deployed and creating that positive equity curve. Okay, but you can only do this if you have clear rules that have been rehearsed time after time, okay, that have been tested, proven, and allow you to deal with this uncertainty. If you deviate from the rules, you'll have anxiety. Because you won't know if you're deviating from your own rules. Okay, so number one, it's counterintuitive, but why spend hours and hours and hours creating a trading model and testing it if then you're going to deviate from the model? It doesn't make sense. So if you spend the time to study a model, stick with the model. End of story. Okay, that's at least you know where the responsibility lies, and you're not fretting over impulsive decisions that you've made that have ruined your equity curve. Because remember this, it's not in this presentation, but in the other presentations I've talked about unforced errors and mistakes. Any deviation from your plan is a mistake, and mistakes can be expensive. Okay, so let's just imagine if you were to follow your trading plan precisely and you only have 10 trades in a whole month, but if those 10 trades deliver, let's say you have an 80% win rate because you're super disciplined and it was a great month. So 8 of those 10 trades are winners, 2 are losses. Your losses are smaller than your wins, so you have a tremendously positive month. Okay, but you only traded 10 times and you were able to sit on your hands the rest of the time. Compare that with the trader who's trading 10 times a day, wins and losses, wins and losses. Yeah, he might be good, he might come out positive at the end of the month, but who worked smarter? Who was more efficient? Who was more disciplined? Who stuck to the process more? Okay, it does go down to this. Trade less, trade like a sniper, follow your system, and always try to enhance your system. Don't jump in the market just because you see something. Okay, if you see something, then study it, rehearse it, see if you can build a second system around it or enhance your own system on a demo first. Don't do things, because the more you deviate, the more you take, whatever trades, the more you'll impact your equity. And any of those mistakes, any of those deviations from the plan will then have to be recovered. Okay, it's like, you don't want to give back. I should say this a different way. You want to give back the least amount possible. You want to keep as much as you can from the markets. Okay, so you have to reduce your mistakes. And once again, it always goes back to the process, following the process and not going off on a tangent. So what is one of the other issues I've encountered with people that fail to follow the process? It is the frustration that even though they have a setup, they might still get stopped out. So, what's going on here? I study a setup, I go through all that work to learn a system, and yet even when I have a setup, sometimes I get stopped out. And that's frustrating. Why? It's because there's a difference between the setup having an edge, having a statistical edge, which is in the realm of probability, and what we want in our minds, which is certainty. Many traders tend to connect the setup with a certainty of the outcome, whereas the setup is only the opportunity. Okay, so I play pullbacks. Let's talk about pullbacks. I play pullbacks. When the market is pulling back, my window of opportunity opens up. Okay, does that mean that I will have a profitable trade just because we're in a pullback? Absolutely not. So I've learned to discern different kinds of pullbacks on different time frames, different conditions, and I like certain combinations of them. But still, even though I have my preferred pullbacks because of the way that I have studied the markets, does that imply that I will have a winner each time I have a setup? Absolutely not. There is no certainty. That's only opportunity. But again, we have to go back to the mathematics of professional gambling here in the markets. Good opportunities are only the ones that will give you a higher reward compared to the risk of that trade, of that opportunity. So I only take the opportunities that will give me, that I can see beforehand, logically, with all available information at that time, that have enough space to give me a much larger win compared to the loss, compared to my stop loss. Okay, so it goes back to the process, and it goes back to understanding that there is no certainty. There are probabilities, and the better we are at stacking the odds in our favor, so waiting for the appropriate moments and waiting until the risk reward is stacked strongly in our favor, the better our results will be. But we can't attach any kind of expectation to any single trade. And actually, the opposite is true. It has been demonstrated that people that actually expect to lose and that plan for the worst case scenario, that prepare themselves for the worst case scenario, are better off psychologically, because if things go well, then it's all gravy. It's all added benefit, because they were expecting things not to work out. Most traders instead expect to win all the time, and it's really, really important to them to win, and so they just never go anywhere in their trading. It's that right-wrong mindset. So moving forward, let's talk about self-chatter. Okay, this happens to the best of us, even people that have a system. Okay, if there is no mindfulness or self-awareness, what happens is that they have the plan in mind. Okay, and it's better to have it written in front of you, but people have their plan in mind and they know what they're waiting for. But then when the markets are moving, they get distracted, and they start to pull up charts over charts over charts, and they lose focus, and they start to look for opportunities that aren't in their main trading plan. So again, it's a lack of discipline, lack of focus. It is being guided by, it's basically being more of an animal than a human being, because animals follow this kind of equation. There's a stimulus and there's an emotional response. Okay, that's the difference between humans and animals. We have the capacity to analyze our own thinking. We have the capacity as human beings to detach ourselves from the emotional reaction, analyze our response, and act in a different way. Okay, so when you're looking at the market's moving up and down, and the platform is all flickering with the bright lights. You have to detach yourself from that and say, okay, there are a billion excuses to trade. There is always an excuse to click the button. But what's going on in my mind? What am I telling myself? What am I thinking? Because if you're not at peace, if you're not, 100% focused on your game plan, on your area of expertise, on your opportunity, and you're not dismissing everything else as noise, then you will get caught into this sort of emotional reaction spiral. Okay, so the right thing to do here is to become mindful of your own thoughts when you are sitting in front of your screens. Okay, become self-aware from that mindfulness, from the practice of mindfulness. You develop self-awareness. Okay, and there are many resources on mindfulness on the web. John Kabat-Zinn was the first guy that brought mindfulness into the Western world. So you can just look up his videos on internet. Develop self-awareness. So realize what you're thinking and what's happening in real time. Acknowledge it. Don't judge it. Just acknowledge it. And don't react emotionally. Okay, but react in a more mature way after you've done this process. There was one trader who I helped years ago who had a difficult time at work, and he would, when he got home in the evenings, he would sort of bring his work frustrations into his trading, and he would commit all sorts of mistakes. Over leveraging, trying to get good, trying to get big, chunky wins to feel good about himself after a stressful day at work. So this is exactly the kind of emotional response that'll happen if you don't realize what's happening. So we had to work instead with on being mindful and on self-awareness, because bringing your frustrations from your day job into your trading is a recipe for disaster. As traders, we need to be focused on the process. We need to be focused on our area of expertise, and we need to sort of keep all of the frustrations and thoughts at the door, because it has nothing to do with the markets. It has nothing to do with what's going on. To have that focus, we need to be self-aware. So am I talking to myself in a negative manner? Am I bringing any frustrations from my day job into my trading that's clouding my vision? If you can stop the self-chatter and just observe the markets for what they are, recognize your opportunities, execute those opportunities in a ruthless way, you'll be much better off, because you will be aware that your own thinking creates a pair of goggles, like a pair of glasses, and it's an interpretation of reality. So we need to remove the goggles. We need to strive to be as objective as possible, without giving any emotional significance to the market movements. Prices can go up or down. That doesn't mean anything. They're just going up and down. Okay. If we're in a trade and the market goes a bit in our favor and then it retraces, that means nothing on a personal level. It is just the market absorbing and digesting the orders that are being thrown into it. Okay, so there is no significance whatsoever to market movements except for what you give to it. Okay, so I always strive for objectivity. I stop my self-chatter, and I'm always focusing on what the market is doing. Okay, you have to just trust price, basically. Observe the market, know what you're looking for, wait for it, execute. And don't tell yourself any stories about why certain things are happening, or bringing any frustrations from your work or from your family, from the day into the markets, because that is a recipe for disaster. The more you can calm the mind, the more you can find peace through mindfulness, through gratitude, some people through prayer, the more you can actually be in the present moment, like breathing in the present moment. And that will allow you to be a much more effective trader. So, solutions. Okay, we've talked about a lot of issues that affect traders. Okay, so not having a process in the first place, not understanding the mathematics of professional trading, professional gambling, focusing too much on the money and on what money means to certain people, and then getting emotionally connected to your trades. What are some solutions? Okay, we need to recognize and accept what is out of our control, and we need to know what is under our control, and we can manage that. So what is out of our control? What do we need to simply accept? Number one, that losses are part of doing business. Okay, losses are part of doing business. There is no way to escape that fact. And the only way that you can actually dismiss losses is if you have larger gains. And that goes back to the process and trade management. You need to find ways to let your winners run, to manage your winners so that they are, that you can allow the market to go on as long as it will without, putting a take profit, putting a decisive cap on your winners, but also trailing your stops and not letting the market come back too far so that you won't experience 1 hour losses. You won't experience full losses. Okay, if you can do that, then you will be able to accept this fact in a heartbeat. Second thing, accept the fact that your trading results are a result of your skills and your capacity to act on those skills. Okay, and that's why we talked about the kaizen wheel of continuous improvement. Your skill set is always improving. The more experience you have in the markets, I should say the more relevant experience you have in the markets, so the more you're working from the same angle month after month, the more relevant experience you're gaining, and the more effective a trader you'll be. So your results you're directly responsible for your results. End of story. You can't force winners. Okay, again, that goes back to the winning-losing mindset. Okay, you can't force winners, so don't even try. And always take total responsibility for your results. Okay, everybody gets what they want from the market. Some people get excitement. Some people will get whatever. What we're striving for here is to be objective, and we're striving to act as professionals and to make a living off of the market. So in order to get that, we have to take total accountability and responsibility for our results and know that it is down to us. Learning how the markets move, implementing a structure that allows us to make sense of the madness, and executing that structure and always trying to improve it, following the kaizen wheel. So now let's go on to the opposite side of the spectrum and find out what is under our control. What can we control? Well, we control where we get in the market. Okay, so when we get in the market, where and how. We control the position size. Okay, how much are we going to risk when we get in the market? And we can control the exit. When we exit, why we exit, and how much we exit. Okay, so we need to realize that where most traders focus just on the entry, we should probably spend more time focusing on position size and exit so that we can always sustain strings of losses. And also, once you have a certain consistency, with Sharpe ratios above 1, you can also think about tilting that position sizing model into a more dynamic model. Okay, so where you're risking, where you can actually increase the size of your bets bit by bit as you win, and you scale back bit by bit as you lose. But that's more advanced, and it only works if you have a Sharpe ratio that is above 1.5. So the main area then to focus on is your exits, your trade management, because at the end of the day, we can get in the market will do whatever it does, and we need to have a plan to react to that so that we can keep our losses as small as possible, but let our winners run. And that's why the act of scaling out doesn't really work, because if you scale out, if you just scale out randomly, or you scale out just taking profit because the market has moved in your favor, okay, and you don't do it because there's an actual reason the market is falling back or the market is starting to underperform, then you're just putting a cap on your winners. So, what we should be trying to do is to trail stops and find ways to let the market move in our favor until it really looks like it's turning around, or there's an opposite signal or something. We have to get into that mentality of riding our winners. So, this is what's under our control. The other thing that I'd like to mention is, going back to the process, is a checklist. Having a simple checklist. I mean, every high pressure job, and trading is a high pressure job by all means. Every high pressure job has a checklist. Surgeons, airplane pilots, first responders. My fiance was a first responder, and they all have checklists. They all have fail safes and backups. So your checklist will free up mental space, and the more mental space you have, the less emotional you'll be, because you'll be able to be self-aware. You'll never be rushed. You'll always be in control. You always feel in control of your results. So have a checklist, for identifying the big picture and intermarket connections, identifying what to trade and why, identifying your entry conditions, your position size, and your trade management. Once again, the more you work on the process, okay, and you stack the odds in your favor, the more you will be an objective decision maker and a ruthless sniper trader, which is what we want to be. You'll be, a systems thinker and less emotional. And then when the system works, just wash, rinse, and repeat. And the system won't work every time, which is again why you need to cut your losses and let your winners run. Let's take a step a little bit away from the process and the mathematics. Let's look at the masters, the best traders in the world, and what their belief structure is, how they act. And at the core, okay, so eliminating all the fluff, eliminating all of the big discussions on, all the philosophical discussions on beliefs, on mindsets, on this and that. What actually makes a difference? Locus of control. You need to be an independent thinker, make your own decisions, and take responsibility for them. Okay, people that rely on others usually aren't good traders. Okay, and there are people out there that, for example, use other people's signals to try and get a funded account, and we've seen this. This has happened. People will try to use signals from other signal providers, trading those signals on an account with us, trying to get funded. Okay, but these things don't last long, because when you get into a conversation with the trader and you actually ask him to explain why he's taken certain trades and why not others, etc., he can't do it. He can't explain it properly. Something's off. Okay, so lies don't have long legs, and they catch up with you. Have an internal locus of control. Take responsibility for your actions in the market and for your trades. For example, if you come to our Trader Academy, sure, we teach you some methods. We teach you some setups. We teach you some trade management practices. But then it's up to you to take that information and act on it, with a structure that you build, and take responsibility for it. Okay, because the way I apply certain information, the way you apply certain information can be different, and it should always reflect our own personal, the way we view the market. Certain things make more sense to me. Certain other things make more sense to you. Some people are more wired to intraday. Some people are more wired to swing. So, you will use that information in different ways, but you have to ultimately take responsibility for the process. Second thing, process versus outcome. In my experience, the losers are focused on the outcome, whereas the winners are focused on the process. Okay, the process is what is under your control, not the outcome. Okay, we have to have process-oriented goals and not outcome-oriented goals. Your trading career will flourish. It'll be great if you focus on the process and you develop a great process. If you continue to focus on results, on forcing winners, etc., you'll never become a professional trader. Resilience. Okay, resilience means being able to claw back from drawdowns, being able to get back up after taking a ton of hits. Okay, and we need to face life and trading using the Super Mario effect. Now, I didn't create the Super Mario effect. It was actually Mark Rober who talked about the Super Mario effect. And it's basically returning, it's basically living life as if we were learning how to walk again. When we were learning how to walk, number one, we had a caring family around us, hopefully. We had somebody that wasn't judging us and not pointing out that we were falling and stumbling and we were awkward. But we had people around us that were encouraging us, saying, you fell down. Oh, don't worry, it's nothing. Get back up. And we weren't judging ourselves. We weren't criticizing ourselves just because we fell down. Otherwise, nobody would learn how to walk. Okay, this is a Super Mario effect. It's like playing a video game where you're always trying to get, to end the game. You're always trying to finish the level, get to the next level, beat the boss, move on. And each time that we get defeated, it might be frustrating for a moment, but we get back up, we get back into the game, and we start playing again. This is a Super Mario effect. We need to face life and our trading in the same way. The moment we have a setback of some sort, get back up, find out what was wrong, fix it, try and move forward. Don't take it personally. And in life, importantly in life is a feedback mechanism. So look at your results in life. Have you been trying to achieve different results doing the same thing? Have you been taking, your whatever has been happening to you personally? Or have you been confronting it with a mindset of resilience, using the Super Mario effect? Just looking at life, what it's giving you, and saying, I don't really like this. I think I need to change something. I need to try something different because it's not exactly what I wanted. Don't look at your life in terms of, or your trading life, in terms of failures and successes. It's only feedback. It's only a game. So it's what you do with that feedback that counts. It's what you do with the information that you're receiving, with that feedback you're receiving. It's just like in a video game. Why did the boss beat you? What is the mechanism you have to learn? Where do you have to get better? Where do you have to improve? That's what it's about. That's resilience. Never giving up. It's hard to beat a person that never gives up. And discipline. Create good trading practices. Okay, create the checklist. The checklists help you stick to certain habits. The good habits will transform you into a disciplined person. It's not the other way around. Okay, the discipline comes by being that person, by following those habits, by imitating or emulating the people that you want to become. Okay, and it's not the other way around. So to change who we are, we need to change our habits, and we have to be that person. Something else that I might suggest is to journal yourself and your trades. Before I read this, I'm just going to have another sip of water. Okay, self-awareness. So this is connected to what we talked about before. When you sit down at your screens, what are you telling yourself? What's going on in your mind? Are you even aware of it? Okay, because the stories we tell ourselves about the markets influence our decisions. So write down, what you're thinking before you enter a trade, when you are stalking the trade, when you're waiting for the trade. Write down what's going on in your mind, and you will notice doubts pop up. You will notice uncertainty, feelings. Write them down, identify them, understand how the market really affects your mind, and work on that. Okay, and strive to be objective. Because once you recognize it, you're probably 90% there to already dismissing it and becoming more objective. But if you don't recognize it, it will dominate you. In coaching, in coaching practice, something that we learn is that until we are able to identify subconscious patterns, we will be dominated by them. So anything we are not aware of, just like our own thought processes, our own feelings or emotions that pop up when we're waiting for a trade, when we're looking at the markets, it will dominate us. It will control us. Okay, so we need to become aware of that. And then journal your trade ideas. Okay, and to emulate a best practice, I start the day before. In the evenings, I take note of where the major moves were during that day, where the major flows were. I look at the intermarket, I connect the dots, and based on the day's performance, based on my own ranking criteria, based on my own filtering criteria, I will write down a series of opportunities, if there are any, opening up for the next day, so that I've already planned. I've already planned my trades. I've already planned my ideas. And then the next morning, you see what's happened overnight and see whether your ideas are worth pursuing, if you have to adjust them, or if something actually changed, something new popped up. But if you don't have, if you don't start with a plan, then it'll be a lot more difficult, and you might sort of lose focus. And then when you are executing your trade, okay, just to ask yourself, if I were to take 100 trades just like this, how would I feel? What would the result be? And that is, risk intelligence. That is the mindset of professional gamblers, because it's not about what's going to kill you today. It's about what will kill you in the long term, and vice versa. It's not about what's going to make you a winner today. It's what is going to make you a winner forevermore. It's what's going to allow you to survive as a trader forevermore. Okay, so it has to be that kind of mindset. If I were to repeat this trade every day, for the next 100 days, what would the result be? And usually that allows you to obtain a perspective on the kind of trade you're taking, if it's a poor trade or if it's a potentially good trade. Okay? And lastly, this should be in bold: errors. Errors are simply not following the plan. Losses are not errors. And once again, always remember that if there are issues in your trading, you have to take it back to the process and improve. Identify the issue, develop countermeasures, determine the cause, develop solutions, implement them, see what happens, measure. Remember that nothing can be, only if you measure something can you actually manage it. If you don't measure it, you can't manage it. Okay, so that's why we need to connect our accounts to like MyFXBook, or if you want to send me your account statements, I have an Excel. I can drop the statistics on Excel, but always measure your trading performance, because you have to know exactly what needs work and what doesn't. Okay, there are numbers. We need to work with the numbers. So it's continuous improvement. And we've talked about the process forevermore, so we can skip this. Now, finally, before I open up the room for questions, if you do need help, remember you can subscribe to our Thought Leadership blog, so you'll always get, our webinar, our next webinars directly into your inboxes. You'll get our blog posts, our morning calls with trade recommendations and ideas. Any blog posts or videos that we do, everything will be delivered into your inbox. And you can go there to news.fci-markets.co.uk. That's where you can subscribe to this. Follow our Twitter calls. That's something, we only put out the most important market moving news and the best looking charts that we're seeing in real time. We try to have a very high signal to noise ratio. If you're just starting out, I'd encourage you to subscribe to our free course. These are 15 years of trading experience condensed into concise lessons. Okay, just go to fci-markets.co.uk/promotions/free course, and you can find this there. Or if you want to become a professional and get funded, come to our academy, fci-markets.co.uk/academy. And it's an interactive environment, constant coaching support, and successful candidates have a funded account waiting for them at the end of the course. So, again, we're giving you all the tools necessary to become a professional trader. And with that said and done, let's open up the stage for some questions. Okay, so good question here. So I have experienced losses for the past 2 days with a system that I believe. Should I just keep going with the system or should I stop? Okay, that's a good question. So how do we solve this? Number one, have you been using the system for a long time? Because if you have been using the system for a long time and you've been executing it in a systematic manner, then you should know whether this sequence of losses falls within, the falls within normality, or whether it's quite strange and something is off. So the first thing is, your experience with the system and whether something has changed or not. The second thing is, are you executing the system exactly the way you usually execute it? So are you taking, if you're playing pullbacks, for example, are you playing pullbacks, or are you mixing pullbacks with breakouts? Because the markets have been moving a bit better these days and there's a bit more volatility. So it's tempting to sort of jump on moves just because the market's moving. Okay, but again, that's a deviation from the system. So it really goes back, so again, it goes back to, am I executing the system with the setups in the correct way and things are still going wrong, or am I letting the market derail me? Am I just jumping into trades because the volatility is higher? And of course, that's a deviation from the system. And that means that you're not actually trading the system. So it's not the system's fault, it's your fault in that case. But this is why, see, this is the importance of following a process, because if you follow the process and something's going wrong, then you analyze the process. If you have a process, but you've deviated from the process, then you know exactly what's going wrong. You've deviated from the process, so you get yourself back in line and you follow the process. And that's that's the first thing I check. Okay, so first thing is, if I am executing the process consistently and things are going wrong, have market conditions changed? Because I haven't changed. The system hasn't changed. So maybe market conditions have changed. Has volatility contracted a lot? Or has volatility expanded so much that things have changed? Like back in March. Let's say somebody who was used to playing hourly pullbacks, back in March, playing an hourly pullback might have had a stop of 200 pips. When we had this whole coronavirus thing going through, that's huge. So the position size would have been tiny, and the volatility was such that holding trades for 2, 3, 4 days just really had an unacceptable value at risk. And so the better thing, so the only thing to do there was to scale it down and trade sort of intraday using smaller term, using shorter term pullbacks. So it's a bit of flexibility if market conditions have changed. And that's one thing. That's one case, right? So you've been executing consistently, but market conditions have changed. If market conditions haven't changed, have you actually been consistent, or have you been sort of random? Because there is randomness in everything. You could be selecting the candidates in the same way, but executing them slightly differently. But that's a variation on the theme. So again, that's something that needs to be checked. Or maybe you've been identifying the candidates fine. You've been executing them in exactly the same way, but you've been managing them differently. Once again, that's a change in the process, so it has to be checked. Okay, it's every step of the way. If there have been variations in each little detail, it's messy. You have to find out exactly what you've been doing differently. This is the kind of analysis that I perform on my own trading, and that I've had to perform, especially when things were really tough. When I was in the bigger drawdowns, I had to go through this process constantly to sort of make sure that I was taking responsibility or adapting to the markets, to the market conditions. That's sort of the process. I don't know. Did that help? Did that answer the question? I tend to digress. And yet, all right. If there are no other questions, then I'm just going to thank you for coming to this webinar. I hope you enjoyed it. I hope it was useful. Once again, it is an honor to be in a position to be here, transferring years of experience to you. So I really hope it helps. But again, if there are any questions or concerns, just get in touch. You can write us to client support. You can give us a call directly, or if you're in the UK, just drop by and you can talk to one of our guys. I look forward to seeing you in our next webinar, and enjoy the rest of your day. This is Justin Paolini for FCI Markets, over and out.